So you've heard on the internet that your ticket to paradise, nothing but mountainous riches and delicious treats, can all be had by the long call option strategy. So let's learn exactly what that is. Hey, Jim Schultz here for F Cubed and livefcubed.com. And the long call option strategy, this is one of the most fundamental building blocks of the whole world of options. Call options, and specifically long call options. Now, this video, admittedly, it's going to be a little bit on the longer side, but what I wanted to do is I wanted to give, especially my beginner traders out there, a really solid foundation of what a call option is. And if you hang with me all the way till the end, we're going to spend the second half or last third of the video working through a real-time call option example using Tesla call options. So first things first, there are only 4 possible basic option types. There's long call, short call, long put, short put. Every option strategy that you might do is always going to be some combination of those 4 basic option types. And I would guess that most option traders actually start with long calls. And this kind of makes sense, regardless of how effective or ineffective they might be, because they most closely resemble something that a lot of investors will already be familiar with: long stock. Whether they're owning individual stocks, whether they're owning mutual funds, whatever. A long call is very similar to a long stock position. So what I want to do is I want to work through the basic principles of a call option and then apply it to some Tesla call options in the real market to hopefully help you see these principles come to life. So every option is a contract between 2 parties, the long side and the short side. The long side is the buyer and the short side is the seller. And these 2 sides are in direct opposition to one another. What one side wants, the other side doesn't want, and vice versa. A phenomenon more commonly referred to as a zero-sum game. So if the long side wins, the short side loses, and if the short side wins, the long side loses. And what the call option does specifically is it gives the option buyer the right, but not the obligation, so the privilege, to buy shares from the short side of the contract in the underlying stock at the strike price before expiration. So let's dig deeper into what some of those terms mean. Now, over the life of the contract, there are certain characteristics that are known to both parties. You have the underlying stock, so like Microsoft or Chipotle or Starbucks, whatever. This is the stock that will be bought or sold between the parties if the option is used, or the more formal term that's often applied here would be exercised. The option gets exercised. You have the expiration date of the option. This is usually the 3rd Friday in every month for standard options. So the March options would expire at the close on the 3rd Friday in March. The April options expire at the close of the 3rd Friday in April, and so on. You also have weekly options and daily options and some of the other, underlyings in the marketplace. But generally speaking, standard options are going to be the 3rd Friday in every month. You have the strike price, which connects to the underlying stock that the option is on. So if you have an option in Microsoft with a strike price of 400, any shares that are bought or sold between the long side and the short side are bought or sold at a stock price of $400 per share, the strike price. This is regardless of what the actual stock price of Microsoft might be. You have the quantity of shares, which is almost always going to be 100 shares per contract. And then lastly, you have the price or cost of the option itself, oftentimes referred to as the premium on the options. All the variables that we've covered here are fixed over the life of the option, with the only exception being the price. It moves as the market itself moves. All right, so those are some option contract basics and features. If you're brand new to options, it might not be a terrible idea to save this video in your watch later playlist so that you can easily reference it, because option contract features and basics and characteristics, they can always be applied to long calls, long puts, short calls, and short puts, what we referenced earlier being the 4 basic option types. So as you're learning those things, it may not be a bad idea to have this guy kind of on file so that you can go back and reference it. Okay, So back to a little long call option explained for both you guys and the YouTube algorithm. Number one, first and foremost, mission critical. I've said this many times before in other videos, but this could be the first video of mine that you're finding, so welcome aboard. I'm very glad that you are here. The best way to think about any option contract, if you're just learning, is the long side buys the contract from the short side. Call option or put option, it doesn't matter. View the contract that way. It will help you immensely. Not only with a long call option like what we have here, but even with understanding market metrics like implied volatility, like days to expiration, like delta, gamma, theta, etc. It's going to help you so much to view the option contract through the lens of the option buyer is buying the contract from the option seller. Now, full disclosure, in actuality, it's a little bit more nuanced than that, and I work through this in a little bit more detail in a video we've already done on the channel showing how you can even sell something that you don't own to begin with. Like, how can I sell options if I don't already have options to sell? Well, I've already worked through that. I'll toss it up in the cards, and I'll link to it down in the description as well if you haven't seen that guy. All right, so now, to bring all these characteristics to life, here is where I want to bring up a Tesla call option from just a couple of days ago. So hopefully you guys can see these different terms and variables, how they come to life in a real live option contract. But before we even do that, here are 3 of the most critical things to understand about long call options. Your potential profits on a long call option are unlimited. This is what makes them so attractive. This is what makes them so appealing. Your maximum losses on a long call option are fixed. They are capped. They are limited to the premium or the cost of the option when you buy it. Again, this is where the attraction, this is where the appeal comes from. Thirdly, if the option is not working, if the stock has gone in the other direction, and which of course with a long call option would be the stock going down, as we're going to see with this Tesla example, if that happens, then you can just walk away. Like, if that happens, you are under no obligation to use the option at all. You can just let it go out to pasture, let it expire, walk away, and be done with it. Okay, so let's dive into this Tesla example, and I'll expound on all of this. And for the purposes of this example, to really simplify the process, we are going to assume that you, as the call buyer, are going to hold the option to expiration. You don't have to do that. There's a lot of other things that you can do that you can consider and moves you can make, but just to simplify the process, let's assume that the call option is held to expiration. All right, so here we are. It's actually Tuesday, January 30th, after the market closed, when I snagged this screenshot. Now, obviously, there's a lot going on here, especially if you're kind of new to trading. I'm not going to be able to unpack everything that we see on this screen because instead, I want to stay focused on what's important in regards to bolstering up our understanding of the long call option. So the first thing you want to notice is the stock price of Tesla. It's about $191 per share based on the closing price earlier. And then you want to notice the option itself, which you can see on this nice green card on the tastytrade platform. What's on the card is the strike price, the expiration, and the cost of the option. So in this case, you have a 190 strike, expiration in 45 days, so on that third Friday in March or March 15th, and the option costs $12.75 per share. Now remember, each contract is 100 shares. So if you wanted to buy this option, it would be a total cost to you of $1,275. All right, so my hope is, at this point, we're going to get back into the Tesla example in a second, but my hope is that now you can see some of those variables coming to life in terms of not just being on some PowerPoint slide, not just being on some random dude's YouTube video. Hey, shout out to this channel, like and subscribe if you haven't already done so. You can see these things come to life in a real live instrument like Tesla. All right, so even more specifically, let's focus on 2 of those variables. The stock price of Tesla at 191 and the strike price of the call option at 190. Remember, what does a call option do? It gives the long side, right, the call buyer, the long side of the call option, it gives him or her the opportunity to buy shares of stock in the underlying stock at the strike price. So again, you have a stock price of 191 and a strike price of 190. All right, so strike price of 190, stock price at 191. I'm the long call holder in this example. If I can buy shares of Tesla at 190, the strike price, at any point before March expiration, don't worry about American options and European options and all that rigmarole right now. We'll come back to that at a later date. It's not important to what we're trying to cover and understand right here. If I can buy shares of Tesla at 190 at any point in the next 45 days, which direction do I want Tesla stock to go? I want it to go higher. I want it to go higher because the higher that it goes, the greater the differential between the stock price and the strike price. Because remember, that 190 strike price is fixed over the life of the option. It's not going to change. Over the next 45 days, it is set in stone at 190. So Tesla can go to the moon. Tesla can go through the roof. And that's only going to be better and better for me, because I'm going to be able to generate more and more profit potential on this option contract if the difference between the stock price and the strike price is greater and greater, with, of course, the stock price being higher than the strike price. So that is why when you look at the green profit curve on the curve view inside of tastytrade here, you see that it is angled up at a 45-degree angle, and there is no ceiling. There is no limit. This is why a long call position is often referred to as a bullish position. It wants the stock to move higher. It wants the stock to increase in value because that is more and more beneficial to the long call holder. If Tesla rises to 200, let's say, that's good because the call buyer can use his option to buy Tesla for 190 when it's actually worth 200. So that's valuable. If Tesla rises to 250, that's even better because, again, he can buy it for 190. The strike price is fixed, but it's actually worth 250. And if Tesla rises to 300, that's absolutely fantastic because, again, the strike price is fixed for the next 45 days until March expiration. He can buy the stock at any time for 190. And here, if it's worth 300, he has an immediate differential positive in his favor of $110 per share. Okay, fair enough, Jim. You might be thinking, that makes a lot of sense, and this looks pretty good. But what if Tesla goes down? What if Tesla drops to 180 or 170 or 160? Well, in this case, hopefully it's clear to see that the call option isn't providing any value to the call buyer. I mean, why use the call option to buy something for 190, right, that fixed strike price, when you can just go into the marketplace and buy the stock for 180 or 170 or 160, whatever price it has fallen to? So that's not going to be good for the long call holder. All right, but lastly, remember that the cost of the option was $12.75 in this case. That's what the long side pays the short side for the opportunity to cash in on a big up move in Tesla. Well, if things don't work out and Tesla falls, the long call just walks away. He walks away. He doesn't use the option because it doesn't make any sense, as we just went through, but he loses his cost. And of course, the short call would profit by that cost. But that is the most he can lose as the call buyer. That is why here on this curve view inside of tastytrade, you can see that the red loss area has a fixed horizontal line at stock prices below 190. So ultimately, it doesn't matter if Tesla falls to 188 or 148 or 48 for that matter. It makes no difference. The long call buyer is simply going to walk away from the contract, lose his $12.75, and then just move on. Okay, but one final thing to note. You see that there's a point where the profit curve crosses the x-axis. This is the break-even point on the trade, and it denotes the Tesla price that essentially leads to a break-even trade for the call buyer at expiration. If you look closely, you'll notice that the break-even point is exactly $12.75 higher than the 190 strike. So a break-even price here of $202.75. This has to be the case Because remember that the call buyer paid the call seller that premium just to hold the contract. So naturally, the call buyer needs to recover that cost before he can start making any profits. Which, if you stop and think about it, this is no different than any other business, really. Right? Like whatever product or service you might be selling, you're going to have costs that are associated with that product or that service. You have, machinery, you have, rent, you have labor, you have all these things. You have to cover those costs before that business becomes profitable. It's no different when you're buying or selling options, essentially. You have to cover any costs associated with the buying and selling of options. And here, since we're specifically focused on, buying call options, you're paying that premium to the call seller. So you have to cover that cost if you want to be profitable on that trade at expiration. Okay, so my hope is that this has been a pretty good foundation for call options for beginners, if you will. Now, of course, there are a million other things going on. I mean, you have, P&L changes, you have, extrinsic values, you have implied volatilities. You might be thinking, Jim, what if I don't hold the option to expiration? Does that change things? Oh yeah, that changes everything. And so there's so many other things going on. But what I wanted to do here was create something that was kind of simplified and stripped down for people that are maybe just learning about options and just finding the world of options for the first time, to kind of cut through a lot of the riffraff and a lot of the rigmarole and just get to, call option basic video to give you a little bit of a foundation to work from. So I hope that this video has been able to do that for you. And I appreciate you guys if you made it all the way through to the end of the video, man. That's absolutely amazing. If you want to like, share, and subscribe on your way out the door, that would be doubly amazing. And I will see you guys next time.